What's going on, people? Ryan Fagan here, back with our loan officer, Drew, and we're going to give you guys some information about what's going on in the mortgage industry. Obviously, there's a whole bunch going on with the president and tariffs and interest rates, so we thought it was a good idea to just do a whole overview and update of what's going on in the market to help save you money and to help you strategize on what you should do when you're buying a house right now. How are you, Drew?
I'm good, man. How you been?
I'm okay.
Back from Kenya.
Yeah.
Had a good time.
My alternate life.
Their alternate life. I love it.
So let's get into the first question. Can you lay out what's happening and why a little bit?
Man, yeah, I can. So, again, pretty much, the government or the new administration, president, he imposed those tariffs on, all the countries, essentially, short of a number few.
And the tariff is a tax on imports.
On imports, that's paid by, again, the U.S. consumers. I'm sorry, the U.S. business owners, rather. What most investors will do, they'll take their money out of the stock market and invest it in the bond market because it's known to be more stable and secure over a period of time. So what that has done...
Because bonds are kind of guaranteed because they're just loans. Stocks are investing in a company and there's more volatility.
Yep. So what that has done over the last couple of weeks, you've seen all the headlines, mortgage rates are trending down, mortgage rates are going down because the uncertainty in the market because of the tariffs has caused investors to pull their money from the stock market because it has been tanking and invest that into the bond market. So when people invest in that bond market, the mortgage market follows the 10-year bond and it slowly brings down the mortgage interest rates.
Well, not slowly today.
Not slowly today. Sometimes rapidly.
What happened with the rates?
So here's what happened in the past couple of weeks because, again, the stock market's been tanking. Everybody's been investing. Rates are going down very slowly. Again, pretty steadily.
From 7 to high 6s.
7 to high 6s.
Right.
Some of the HFA programs were down to 5.875%. So we had a really good run for a little bit. The pause that was just put on the tariffs for 90 days caused the stock market to go crazy, have a pretty decent rebound, but it also caused the bond market to have a sell-off, which increased the interest rates over the last couple of days. Now, there's a bunch of other factors that do play into interest rates, economic data, jobs and things of that nature. But one of the strongest indicators is, again, that 10-year. And again, when that pause was announced, again, rates have kind of skyrocketed the last couple of days.
So from my perspective, guys, it's really important to pay attention to the market, but also I don't think you can predict what's going to happen because if they have a press conference right now, whatever we're saying could change a lot. The rates could go up, they could go down. So I think it's important that and that's why you need a good loan officer who's paying attention, and that's why we're doing this content, is that if the rates go down significantly because it's very volatile, you should lock your rate if you're thinking about purchasing a house.
100%. And so most mortgage companies have what they call a lock and shop option. Some mortgage companies say, hey, we're the best, we're the only ones that do it. Most mortgage companies have the ability, even if you're still shopping for a home, to do what is called a lock and shop. And what that will do is lock your interest rate in for a period of time. So no matter what the volatility is in a market, if the rates go up, the rates go down, if you're in a decent enough position to lock in that interest rate, they can lock it in. And then when you find a home, you don't have to worry about the market going up or down. Caveat to that, there has to be a significant decrease in order for most of these companies to be able to lower your interest rate. So say if you locked in today at a 6.5% interest rate, and by the time you find a house, it's at 6%. Oh, well, I want the 6%. You can't get it because it hasn't trickled down enough for them to say, all right, well, this warrants us to bring your interest rate down because you already locked in this interest rate. Okay, so while it does provide you an opportunity to not have to worry about the volatility in the market, there is that little bit of caveat. Now, if it goes down over a point, most companies have a policy that, hey, if it goes down over 1 full percent, we will bring the interest rate down for you for a cost and a fee. And most of the companies will have a cost and a fee for you to use the lock and shop program, but it is a benefit for you. The other thing with what Ryan just mentioned, your loan officer has to be dialed in right now to the mortgage market. He has to be dialed into what the rates are doing because, again, things happen very fast. Again, just to give you a for instance, I had a client again that was locked, with the state program was at 5.875. The state program interest rate today is up at a 6% now. So it increased over the last couple of days. And again, that difference, on a smaller loan might not make much of a difference, but on a $600,000 loan, that could be $400 in payment. So it makes a huge impact in what you pay monthly. So you have to pay attention and be dialed in. Make sure whenever you guys are looking at properties, send those properties over to your loan officer and say, hey, can you run these numbers? What are the interest rates looking at like right now? If they're not doing that with you already right now currently, because you want to know where your payment is. God forbid you get numbers when you get pre-approved. It's 3-4 weeks in, you find a house and the rates have changed for over a percent. And because you're not dialed in with your loan officer, you didn't even know. So now the payment you thought you had at $3,000 is now $3,700 because the rate has increased over a period of time.
Yeah, whoever you're working with needs to be dialed in right now. Otherwise, you're not getting good service from your professionals. So agents and loan officers should be paying attention to what's happening in the market because it could affect housing prices, which we'll talk about as well. So with all the craziness and everything, with people that own their homes already and maybe they have a high interest rate, maybe they bought within the last year or maybe 2 years where the rates were a little bit higher, what's the refinance market? Are you able to take advantage of that dip? So if we see another dip, whatever happens, they have a press conference and something crazy happens and rates shoot down 0.5%, and maybe someone can save money on a refinance where they're thinking about doing a cash out or whatever they happen to be doing as a homeowner. How can a homeowner take advantage of what's happening right now?
Kind of the same sentiment with home buyers. You have to be dialed in with your loan officer that you purchased your home with or the person that's servicing your loan right now because those dips happen quickly. Interest rates can change sometimes 3 to 4 times a day, depending on what the volatility in the market is. So that dip could happen one day and then we could be back up the next day, and it doesn't make really any sense for them to be able to do it.
Would they have to, so say I'm not even thinking about refinancing, but because I didn't think rates were going down, and then all of a sudden I'm watching TV and I check the market, I see that the rate went down. Can I initiate a refinance and lock the rate from, I don't even have an application in, or do you just miss it? 'Cause, if I'm in the process, do you need to be in the loan process to be able to take advantage of this already? Or could I, if I'm sitting on my couch at home and I'm sitting at 7.15%, would I be, and I see it drop to 6.5, can I take advantage of that?
You can take advantage of it. So I'm going to preface this with the TV gets people excited about interest rates, and that is not the same for everybody across the board. Interest rates are different with every company. One, the national average is a wide range. You figure there's over hundreds of mortgage companies in the country, so that national average is pulling off of everybody, and everybody has different margins. So while it may say the rates dropped to 6.5, that's what the national average is. Your mortgage company may not offer that. And if you're sitting at home on your couch and you see that, you want to reach out to your mortgage lender, the person that did your loan or the person that's servicing your loan, and say, hey, I heard or I saw that interest rates are going down. I want to be able to lock into a lower interest rate today. Can you get me in contact with a loan officer? Or call your loan officer that help you with your home when you purchased it and say, hey, I heard that rates went down. Can we take a look and see if I can lock into a lower interest rate today? That's the way to initiate that. Again, I don't advise going online and filling out an application for like a low rate mortgage or say lower my interest rate, because they're going to ask you a bunch of information. Some of those online providers will run your credit through several different providers, and you don't want that to happen. You want to go to a trusted professional, somebody that you're familiar with, or again, the person that's servicing your loan, because you're going to get the best deal from those people.
So in practicality, you can take advantage of that if I'm not even in the market and all of a sudden they come out with a press conference and are dropping the rate. Or does it take time? Do I need to get my loan application in? Like for homeowners, what does that really look like? Like I call you. So what do you tell me?
So timeline wise, again,
and let's assume this is a real thing. Say I'm at 7.15 or 7.25, and I've seen maybe because the prime rate went down for a short period of time, this 6.5, 6.75 might be a realistic thing. I have a $500,000 loan, so that difference should save me a lot, theoretically.
So,
I call you and say, hey, Drew, what's going on in the market? Can I get my rate lower?
And I'm going to say, hey, listen, it looks like you locked in. When we did your loan at a 7.25% interest rate, let's take a look at your credit. Let's take a look at your financial situation. Make sure you've been, have you had any late payments on your mortgage in the last year? No, I've been paying on time. Have you? Are you still currently employed at your job? Yeah, I'm still employed at my job. As long as you are in good financial standing in your mortgage and in your credit and your finances, you shouldn't have any problem refinancing. Now, there are streamline options for FHA and VA where the employment piece of it doesn't really matter too much, but the biggest piece is making sure that your on-time payments are in line, right, and that your credit score is in a decent enough position. So if those things are in line, your credit's in a decent enough position, your debt-to-income ratio is in a decent enough position, let's look at bringing that interest rate down for you. Let's see what it looks like, because you might think that 6.75 is going to save you a ton of money, but at the end of the day, if it's only saving you $30-40 and it's going to cost you $4,000 or $5,000 to refinance, what's your break-even point?
Right.
How long is it going to take you to recoup the cost of doing the refinance? Do you have to get an appraisal done in your property? Is your property in good enough shape for us to get an appraisal done? All those things play a factor into refinancing when you're doing that.
But so my question is, let's say it is worth it, but that dip on the interest rate was only like literally 48 hours.
So if you call me and it's worth it, and again, because we can do that assessment immediately.
Yeah.
So if it looks worth it to us, we can say, hey, yes, let's get your application in the system. Once the application's in the system, we can send you initial loan documentation. We can get your rate lock that day.
Okay.
Rate lock can happen.
Would you have to submit all your employment stuff again before you lock the rate, or would you be able to lock the rate and then do all that?
I can lock the rate and then do all that. Some lenders will ask you to send you all their documentation in, but because of the volatility in the rate market, again, it makes more sense. Hey, because again, if you don't qualify, we're just going to cancel the loan and you don't pay any money or anything like that.
So, I mean, it makes sense to shoot a shot.
It makes 100% sense to just shoot your shot, see what happens. And again, some lenders have the ability to do a soft pull on the credit to make sure that you're financially in the right spot.
Right.
Or they'll do what is called a mortgage-only credit pull to show that your mortgage history is in good shape if you're doing one of the streamline programs.
Yeah, I think this is applicable for someone that owns a property with a high interest rate, or, it's market, but it's high, and they're kind of savvy and in a good position. It probably makes sense to make that phone call, so pay attention.
Absolutely. So, I'll give you for instance. I used to work at Freedom Mortgage when I first got into the industry. Freedom Mortgage and a lot of other servicers out there, they built their business on doing refinances for people for just 0.25% drop in their interest rate. So that 0.25% might equate to $50. That 0.25% might equate to $150. Sometimes you can refinance to get the mortgage insurance removed from a loan. So that there has to be a net tangible benefit for you as a buyer, as a property owner, for us to be able to do that refinance. So as long as there's a net tangible benefit for you, be it financially lowering the interest rate, removing the mortgage insurance, or getting a lower payment, consolidating debt, all those things are what the mortgage companies call net tangible benefits. So again, there's companies out there that will reach out to you, but if you see it or you hear it in the news, reach out to your loan officer immediately.
And kind of to your point before, and this is really important, is that when you refinance, there may or may not be closing costs associated with that, and you need to balance that with your savings and your goals. But I think, does VA Streamline, can you do that for free?
VA Streamlines, the only thing that they will require you to bring to the table with you is if it's an investment property, they'll require you to bring 1 month of the mortgage payment to the closing table.
What are their costs, whether they're rolled in or not?
The costs are just rolled into the loan balance.
So there is a cost on the VA Streamline.
Yeah, because there's still title fees that are due inside of the process. If any of your escrows are due at the current point in time. So this is kind of a big thing, and a lot of companies use this as a tactic. So they'll say, hey, listen, we're going to roll in the $2,300 for the title costs. Now your homeowners insurance is due next month, so you're going to have to, roll that in as well as a cost. But anything that you're due back from in your escrow account, you'll get back at closing. So whenever a mortgage company closes out a loan, whether you refinance or you sell it, if there's anything left over in the escrow account, which is the taxes and the homeowners insurance, that money will come back to you in a check. So it looks like a little bit of a balance out. So say, for instance, you have to roll in 3 months or 6 months worth of property taxes because the property taxes are due, so we can establish you an escrow account. If there's property taxes and insurance left in the escrow account that from the previous loan, they're going to send that money back to you in a check. So it'll kind of balance out in that aspect.
So this brings up another topic that I want to talk about that has more to do with financial education, is that don't just look at payment, right? Because when you talk about rolling fees into the loan, if your loan's 30 years and you roll $2,000 into it, you're paying interest on $2,000 for 30 years, which could be significant. So your monthly payment could go down, but the total amount of interest that you could pay could be increasing. So you have to be careful about those things, and just in a general financial education. Even if you're purchasing a car, or someone might even want to refinance their car because the car market's very expensive and you want to get your payment down. Even though your monthly payment is less, you could be paying more. So I think that's an important concept for people to understand and be careful about. Because people do just look at monthly payment, and understanding financing is way more than just what your monthly payment is.
Yeah, and you think of the average consumer is worried about their day-to-day out-of-pocket expense. So what is my bottom line going to be at the end of the day this month because I'm living paycheck to paycheck, or I've kind of overspent on my other things. So if I can save $100 here, this is going to save me.
The problem is that's keeping you on the hamster wheel because you're extending out how much you're paying interest, and that's kind of a problem. So I would say be careful about that stuff and make sure you have these considerations. And if you don't know, please find an expert, find somebody that knows this stuff. Because again, a loan officer, Drew will talk to you about your car purchase and kind of help you understand the financing and the dynamics. Because people look at just the monthly payment and say, I could afford it. And that's as far as they think about it. I think you need to be careful about that. Yeah. Buying a house or a car or anything like that, it's important.
Yeah, it's the same thing when people are looking to do cash out refinances and stuff like that.
Yeah, it's a real bad one.
It's rough, so you have to find the fine line of, all right, well, I've got credit cards that are at 30% interest or 28% interest. Do I want to wrap these into my 30-year mortgage at 6%? Does it make sense? On paper, it may make sense, but for your long-term plan, if you're rolling $80,000 worth of credit card debt into a mortgage, does it financially make sense for you? When are you selling? Are you going to plan to sell this house? Are you going to plan to pay your principal down faster so you can eliminate the extra interest? You have to have a financial plan and not just roll that money in there and say, all right, well, yeah, I saved myself $1,500 a month. Great, you did that. Now, what are you going to do to put yourself in a better position so you can either pay the mortgage down faster to save yourself money on the interest that you just added to your loan?
Yeah, so loans are tools, okay? So generally, rolling your credit cards into your house and adding $80,000 to your mortgage, even though your credit cards are 25% and your mortgage is 7%, it feels like you're saving money, but you're also paying interest for 30 years now. And so that's something that you need to think about. Even if your monthly payment overall is less, there are scenarios where that makes sense depending on what you're doing with your life and everything and what your future income may be. But I think these are more advanced considerations that people should be having just about however they're dealing with loans. And so I would say generally I wouldn't want to roll the credit cards in, but there are times where maybe rolling them into your mortgage is okay on a cash out. It just depends. And you really need good people around you, or at least you need to understand more than just the monthly payment. Yeah. I think a lot of people are getting in trouble when that was their only consideration anytime they did a loan. So.
Yeah. I mean, you think about it. So when would it make sense? So maybe you're preparing to sell your house in the next 2-3 years, but my credit is in the low 600s. All right, well, what can we do to consolidate your debt now to prepare you to buy your house in the next year? All right, so can you take out a HELOC? Absolutely, but then you have 2 payments. Mm-hmm. So does doing the cash out refinance at that point, if it's going to make you $1,500 better, in your overall monthly expenses and get your credit score up for the next year, you can save that $1,500 a month, get your credit score in a good spot, and then when you go to buy your home, now your credit's good. You save $1,500 a month over the last year. You've got a little bit more money for a down payment. You're a little bit more liquid when you're out there shopping in the market. And that scenario would make sense.
And guys, like a regular person is not supposed to understand all this. That's why I want to harp on work with somebody that knows this stuff. Don't try to figure it out on your own per se, because it's a lot going on, because your credit score will go up because of the utilization, and that's kind of a complicated thing to figure out all the ramifications of making these different moves. So
Absolutely.
please don't Google it. Even ChatGPT is pretty good, but please just talk to somebody.
Yeah, and if you're doing a chat GBT, take your whatever chat GBT tells you and take it to the professional.
Please.
Hey, this is what my chat GBT explained to me. Does this make sense? Explain it to me like a human and not a bot. So Ryan, we talked about interest rates and how the tariffs had effect on mortgages. What are you seeing in the housing market as far as what it's doing to the sale of homes?
So real estate reacts slower to the market in general for real estate sales. I was excited when I saw that the rates went down, because my theory, and don't make decisions based off of just, because I've been wrong, is that if rates can get close to the fives, the people who bought homes and are in the threes and high twos but want to move, which I've had these conversations all the time. I tell people it kind of doesn't make financial sense right now to move unless you have a really good why beyond finances, because on paper it doesn't make sense, because you're paying more in the purchase price and you're paying more in interest. That's a lot. So a lot of sellers are kind of trapped in their house where they really need a good reason to sell. So inventory has been low, but because of the affordability issue, there haven't been that many buyers. So we're at a 30-year low for sales.
Okay.
So the market's just slow overall. As far as the dynamic between buyers and sellers, I think we're pretty balanced. I don't think we're seeing much increases in the median home price here in our market. But I thought we would see an increase in overall activity and maybe even prices go up if rates stayed low, but now they're not staying low. So it's too inconsistent really to make much of a prediction beyond. I think we're just going to continue in a stagnation with sales right now.
Yeah, and I'll take it too. I had a client that I did a consultation with the other day. And they are afraid right now because of how volatile the market is. That hey, is my company going to go under? Am I going to lose my job within the next year? Does selling my house really make sense? Because if I sell my house and I get a bigger one, am I going to be able to afford it if I get laid off? All those conversations are being kind of huge because that uncertainty is there for people.
Especially if you work for the government.
Oh,
if you work for the government right now, I wouldn't be doing any major upgrades because you don't know what might happen.
No, and again, financial stability is important when you're owning a home, when you're buying a home, because you don't want to be house poor. You don't want to have to live check to check. Yeah, there is unemployment if you get fired, and some of these companies offer severance packages, but you can't lay your hat on that, especially when you have kids and other things going on in life. So you really need to think about those things. And the person I was having a conversation with, her brother, he was in the process of switching jobs. He had lost his job, and he was like, some of the jobs that they were offering before, I was getting offered, 100,000, 110. Now they're only offering 60, 70 because some of these companies are hedging to be like, all right, well, we can't afford to do that right now because our finances may be in the toilet.
Yeah, I think if you have significant assets, if you own a house or something like that, I think you can take advantage of a rate drop. I think that's smart if it makes sense. And again, talk to your professional. Mm-hmm. But if you have assets, I would be pretty cautious about making any big decisions right now. Mm-hmm. Because, again, this video could be irrelevant tomorrow because of what's happening. So I would just be cautious about that. Now, if you're not in the game, you don't have assets, I still think if you can get into something. And again, this brings up a good point because obviously I'm a big advocate for owning real estate. I think it's a cornerstone to wealth since medieval times and even before. But the affordability is an issue, and there's other complexities with owning a home. And is your home an investment? It's kind of a debatable point. So my overarching argument is that you should own some kind of asset. So if you can't afford to buy a property right now, you could either buy with people or invest in equities, the bond market, something, so that, because what's happening is everything's getting more expensive and the people who own stuff are benefiting and the people who don't own anything are losing really bad.
Lost in the sauce.
And I always say, imagine wages keep going up very slowly. and a starter home costs $1 million. You'll never get there. You have to be like an exceptional or a lucky person to get there. And so don't get left behind if you own stocks and stuff like that. You're at least tied to the gains of whatever's happening, regardless of what you feel about politically. Like if you don't own anything, you're going to get left behind regardless.
Yeah, you've got to do something. If your financial position is stagnant right now and you're not invested, you don't own a home, you don't have anything that has the ability to appreciate,
you got to get in the game somehow.
You got to do something.
Yeah, that's the fundamental point.
Now, speak to your investors out there right now. Like, are you seeing any opportunities on the investment side?
Selling properties, to be honest. I mean, that's what it's looking at. I'm selling a property I bought in 2010.
I was going to say, tell me about that.
Yeah, I'm selling a property I bought in 2010. It's a property in Texas, 4 units, my first investment property. It's worth more than double. I bought it for $176. I sold it for $380. Okay. And it has a whole bunch of maintenance that it needs and stuff like that. So if I fixed it up, probably it'd be even worth more. But the way the market is, I feel like it could be at a tipping point, and I think I'd rather have liquid cash. And I built my whole life on real estate, okay? But if I can get into, Tesla was up 22% yesterday. Why do all this with the property and title and all that, and renting the property and evictions and all that stuff when, you might be able to hit 10% in the equities market, Bitcoin? And I'm not advocating for you to invest large sums of money in this stuff, but the way that I look at it is like...
But I hear that, and I hear you invested in real estate. You took the steps necessary to maintain that property over a period of time. You gained double what you bought the property for, and now you have liquid cash that you can invest in equities and things of that nature to be able to build your wealth even further. So
that's the struggle I'm having right now, honestly. It's and a real candid conversation about this is like, it was easier to get in, and also real estate, because you can borrow so much money to get an asset that appreciates in value. It's so amazing of a thing. I don't know if it's the same as then, though, and I think that's unfair, and I always get concerned about affordability, and I do think legitimately the opportunities are less for people today, and I don't know the solution or what they should do exactly, because I'm in a different position now, so my bias may be a little bit different. That's why I was saying you need to own something. I would say 5-6 years ago, I'd say you need to own real estate. Now I'm saying you need to own something. And because I don't know what the future is right now, because the market has been up since 2010. And that's not normal for any cycle. So I get a little afraid to push real estate investing too hard, because on the short term, it might be down. Plus, my views on debt have changed a little bit. So, yeah, a little concerned.
I would say, I know, again, we've been up since 2010. But, I even look back at 2008 when, we went through the crisis and everything like that. The statistics show that if the people that had went through the financial disaster then have held onto their properties, they'd be double what they
I look at that chart all the time. The median home price at the top of the 2008 housing bubble was $250,000, and we're at around $450,000 median. So at the bubble price, you still almost doubled if you were able to hold on to the property. The problem is, though, is that it depends who we're talking about. If we're talking about someone that is not a savvy, sophisticated person, I think there's a lot of risk, because they might not be able to hold on to what they have if they lose their job or something like that. It could be a disaster. Mm-hmm. At the same end, people's spending habits is not always the best. So with those people, my advice is a little bit different than maybe an investor that is a little bit more sophisticated and understands what's going on. I might tell them to take more risk, because I don't want to promote something and then they buy a house and they don't really have that much reserves, but they were buying a house because they feel like they have to get into the market, and then they lose the house or can't afford something. I think I wouldn't sleep good at night about that. That's my concern. But you have to get into the game, because I believe there's gonna be a permanent underclass of people that there's gonna be people who own stuff and they're all gonna be considered rich people. And then there's people that just work for people and never own anything. And I think that's the way the economy is going if something doesn't significantly change. And I want everyone that I know to be in the owner class of people.
Yes.
But reaching out to get there, you can mess it up. Is kind of like what I'm worried about.
I mean, I was having this conversation the other day. I run a networking group up in North Jersey, and people are like, is now like the time to buy? And I'm like, listen, the time to buy is when you're financially able to buy a house. That's the time to buy. When you can buy a house, pay the mortgage, put away, invest in the stock market, that's the time to buy when you're financially stable enough to do so without stressing whether you're going to have to live paycheck to paycheck because you bought this investment. Again, maybe buying a house isn't for you. Maybe you can buy, like Ryan said, put it in the stock market. Maybe you buy a garage and rent the garage out or something like that. Maybe it's a lower cost or something like that. There's a ton of different ways that you can, invest in the opportunities and grow your money and things of that nature. And again, you said the affordability thing, and getting into the investment market back then versus getting in the investment market now, I think the opportunity is still there. You just have to do it differently. Like buying with other people, you have to pool resources right now.
Yeah, so we're going to talk. That's a really big point, and that's an initiative that we're both kind of working on as far as educating about buying together, group economics, working with family. I think that's going to be the future for a lot of people, but we're going to talk about that next week because I really want to cover that really well. And I think this is a good place to wrap. Hopefully this information was helpful. Let us know how you feel about this format, if you liked it. I definitely want to know what your guys' perspective, especially on near the end of this conversation about, getting into investing now versus back in the day, and what you guys are looking at in the market and what questions you might have.
Yeah, that's all we got. If you got, remember, if you guys are home buying or shopping right now, make sure you get in touch with your lender. Keep your ear to the ground. Make sure you know what's going on with the rate market. Watch the news on occasion. And that's it, guys.
See ya.